Basel 3rd. Deadline. Banks compelled to maintain 85% physical starting Monday. 36 hours from now, a regulatory clock stops ticking. Monday morning, February 9th, 2026. Every major bank on earth faces a choice they cannot negotiate. 85% physical reserves, or regulatory extinction. This is not a market correction. This is not geopolitical tension. This is a forced liquidation event, hidden inside a compliance deadline, that 99% of the financial world ignored until 48 hours ago. The paper markets are about to meet the physical truth. And what happens next will redefine how precious metals are valued for the next decade. The question is not whether this happens. The question is whether you understand it before Monday's opening bell. Welcome to Metal and Macro. If you've spent decades watching markets, navigating economic shifts, understanding that real intelligence isn't found in headlines but in regulatory fine print, then you're in the right place. We'd be honored if you'd subscribe. Think of it as marking this channel. The way you'd bookmark critical research, you'll need to reference again. And tell us, where in the world are you watching this from today? Now, let's break down what Monday morning actually means. On Saturday, February 7th, 2026, something shifted in the global financial architecture that most people completely missed. While retail investors watched silver climb 3% and gold tick steadily higher, attributing the movement to weekend speculation or geopolitical rumors, institutional trading desks across London, New York, and Zurich were experiencing something far more serious, a regulatory countdown that had finally reached zero. The movement in precious metals that weekend was not driven by Chinese demand. It was not driven by inflation fears. It was driven by compliance officers inside major banks reading a memo from the Bank for International Settlements that carried one unmistakable message. Monday morning is non-negotiable. February 9th, 2026 marks the final enforcement date for the net stable funding ratio requirement under Basel 3rd. This is not a new regulation. Basel III has existed in various forms since 2010, delayed and postponed repeatedly over the past 15 years. But what makes this Monday different is the end of transitional grace periods, the end of negotiated exemptions, and the beginning of strict enforcement tied directly to banking licenses. The Bank for International Settlements, often called the Central Bank of Central Banks, sent formal notifications to every systemically important financial institution on the planet. The language was clear. Compliance with NSFR calculations is now mandatory. Balance sheets must align with the new asset classification rules by market open on Monday. There are no extensions. There are no appeals. For most people, Basel III sounds like abstract regulatory jargon. But beneath the technical language sits a fundamental reclassification of how banks must treat precious metals on their balance sheets. And this reclassification creates an immediate crisis for institutions holding large positions in paper, gold, and silver. Under the previous Basel II framework, and throughout the transitional Basel III phase that the world has been operating under, banks were allowed to treat unallocated precious metals as low-risk assets. Unallocated metals are paper claims, futures contracts, exchange-traded funds without full physical backing, derivative positions that represent claims on metal that may or may not actually exist in a vault somewhere. These positions were classified as Tier 2 or Tier 3 assets, requiring minimal capital reserves. A bank could hold $1 billion in short positions in the silver futures market and only need to set aside a small fraction of that amount as a regulatory buffer. This structure allowed banks to create effectively unlimited synthetic supply in the paper metals markets, writing contracts, issuing claims, and managing price through derivative volume rather than physical metal. But under the NSFR rule activating Monday morning, unallocated precious metals are reclassified as high volatility illiquid assets, and high volatility assets require an 85% cash reserve. Let that sink in for a moment. If a major bullion bank is holding $1 billion in paper short positions, they now need $850 million in Tier 1 capital sitting in reserve to balance that exposure. Tier 1 capital means the highest quality reserves: cash, government bonds, physical allocated metals. This is not money they can use for lending, trading, store operations. This is money that must sit idle as a regulatory cushion. Now compare that to allocated physical gold and silver, physical metal that actually sits in a vault with clear title and custody. That metal is classified as Tier 1, zero risk weight assets. It requires no additional reserves. The regulatory incentive structure just inverted completely. For 15 years, the system rewarded banks for holding paper and penalized them for holding physical. As of Monday morning, that equation reverses. Paper becomes expensive, physical becomes preferable, and banks have less than 36 hours to adjust positions that took decades to build. This is not a market dynamic that can be unwound quietly. This is not a position that can be hedged away over a few weeks of careful trading. This is a regulatory guillotine with a visible timer, and every major institution in the precious metals market is watching that timer count down. The question facing every chief risk officer in global banking right now is simple but brutal. Where do they find $850 million in reserves for every $1 billion of paper exposure? And what happens to the price of physical metal when every bank on earth is trying to buy it at the same time? Monday morning is not just another trading day. It is the moment the paper markets meet the physical limits. There's a number that exists in the derivatives market that most business professionals have never seen, but it explains everything about what is coming on Monday morning. The paper-to-physical ratio in the global silver market currently sits at approximately 250 to 1. For every single ounce of physical silver that actually exists in registered vaults available for delivery, there are 250 paper claims against it: futures contracts, ETF shares, unallocated accounts, synthetic positions built on leverage and rehypothecation, all of them representing ownership, all of them legally binding, and all of them assuming they will never be called at the same time. Until now, that assumption held. Banks operated under a regulatory framework that allowed this structure to exist without consequence. But the NSFR enforcement on Monday does not ask whether these positions are profitable. It asks whether they are compliant. And compliance requires capital reserves that most institutions simply do not have sitting idle. The London Bullion Market Association processes approximately $20 billion in gold and silver transactions daily. The COMEX Futures Exchange in New York handles another $15 billion in notional value. Between these two market centers sits the majority of global precious metals price discovery and the majority of institutional short exposure. Data from the most recent bank participation report shows that 4 major U.S. banks hold a combined short position in COMEX silver futures, exceeding 80,000 contracts. Each contract represents 5,000 ounces. That translates to 400 million ounces of silver, roughly half of annual global mine production, held as a short bet by just 4 institutions. In Europe, the concentration is even tighter. 3 bullion banks dominate the London unallocated market, holding positions that dwarf the physical inventory available in the entire LBMA vault network. These are not speculative trades. These are structural positions built over decades to manage client flow, hedge mining forward sales, and provide liquidity to industrial users. But liquidity provision and regulatory compliance are not the same thing. When the NSFR calculation hits these balance sheets on Monday, each $1 billion in unallocated exposure triggers an immediate $850 million reserve requirement. For a bank holding $10 billion in paper positions, that is $8.5 billion in capital that must be reallocated away from lending, trading, and operations, or the positions must be closed. And here is where the mathematics becomes impossible. These positions cannot be unwound in 36 hours. The physical metal required to close them does not exist in accessible form. Global registered silver inventories across all exchanges total less than 1 billion ounces. Industrial stockpiles are committed to manufacturing. Government reserves are not for sale. Mining production is contracted months in advance. Even if a bank wanted to buy physical silver to convert their unallocated positions into Tier 1 allocated positions, there's not enough metal available to purchase at any reasonable price. The market structure assumed these positions would be rolled, hedged, or cash settled indefinitely. It never anticipated a regulatory requirement that would force simultaneous physical conversion. This creates a choice that no chief financial officer wants to make. Option 1. Raise $850 million in reserves for every $1 billion in exposure. That means selling other assets, calling in loans, reducing credit availability, or tapping emergency funding lines. It means explaining to shareholders why billions in capital are now locked in regulatory reserves instead of generating returns. Option 2. Close the positions. Buy back the shorts. Deliver physical metal to counterparties, and accept whatever price the market demands when every other bank is trying to do the exact same thing at the exact same moment. Option 3. Default. Declare force majeure. Cash settle contracts at current paper prices and accept the litigation, reputation damage, and potential loss of banking license that follows. None of these options are good. All of them are expensive, and the decision must be made before Monday's opening bell. What makes this particularly dangerous is the interconnection between institutions. These are not isolated positions. They are part of a complex web of hedges, swaps, and counterparty agreements. When one bank moves to close a position, it creates exposure for another bank on the opposite side of that trade. When that second bank moves to hedge their new risk, it triggers margin calls for a third institution. This is not a market correction that unfolds over weeks. This is a liquidity event that cascades through the system in hours. And the most concerning part? This is happening in a market that already shows signs of physical tightness. Premiums for physical silver coins and bars have been elevated for months. Delivery delays from mints and refineries have stretched from weeks to months. Industrial users are stockpiling ahead of expected shortages. The regulatory pressure from Basel III is landing on a market that was already stressed, and it is forcing every major participant to move in the same direction at the same time. Monday morning will reveal whether the institutional infrastructure built around paper precious metals can survive contact with physical reality. The outcome is no longer theoretical. There's a moment in every financial crisis when the machinery that everyone assumed was permanent simply stops working. In 2008, it was the overnight lending market. Banks that had borrowed and lent to each other for decades suddenly refused. The mechanism froze, and within 72 hours, institutions that seemed unshakable were calling government lifelines. In March 2020, it was the Treasury market, the most liquid, most trusted market on Earth. Seized. Dealers could not find buyers. Spreads exploded. The Federal Reserve had to intervene with unprecedented force just to keep the machinery turning. What is about to happen on Monday in the precious metals market follows the same pattern, but with one critical difference. This time, the breakdown is not accidental. It is engineered. It is the inevitable result of a market structure that separated price discovery from physical reality and a regulatory deadline that is forcing those two things back together. For decades, the price of silver and gold has been determined not by the physical metal changing hands, but by the volume of paper contracts traded on exchanges. When someone checks the spot price of silver, they are not seeing the price of metal in a vault. They are seeing the price of the most actively traded futures contract, a derivative that represents a promise to deliver metal at some point in the future. This system worked as long as everyone agreed to play by the same rules. Producers sold forward production. Industrial users bought forward supply, speculators traded the volatility, and banks stood in the middle providing liquidity by writing contracts that they hedged with other contracts, creating a self-referencing loop where paper traded against paper and physical delivery was the rare exception. But that system depended on one critical assumption, that the paper and the physical would always trade at roughly the same price because arbitrage would keep them aligned. If paper silver traded cheaper than physical, someone would buy the paper, demand delivery, and sell the physical for a profit. If physical traded cheaper, someone would sell paper and buy physical to hedge. Arbitrage only works when delivery is possible, when the physical metal actually exists, when the logistics can move it from vault to vault, when counterparties have the capital and willingness to honor contracts. Monday morning breaks all of those assumptions simultaneously. When banks face the 85% reserve requirement, they do not have the option to slowly unwind positions over months. The regulation is binary. Either the reserves exist on the balance sheet by Monday open, or the position is non-compliant. There is no grace period for logistics. So what happens when a bank holding $10 billion in paper short positions realizes they need $8.5 billion in reserves they do not have? They attempt to close the position. They go into the market to buy back the contracts they sold. And when they do, they discover that every other bank with the same problem is trying to do the exact same thing. Bid prices spike, contract volume surges, and the paper price starts moving in a way that has nothing to do with supply and demand for physical metal and everything to do with regulatory panic. But here is where the mechanism breaks. Industrial users who bought silver futures months ago expecting to take delivery and use the metal in manufacturing suddenly find themselves on the other side of a trade with a bank that cannot deliver. The bank offers cash settlement at the current paper price. But the industrial user does not need cash. They need metal. They need 5,000 ounces of silver to keep a production line running. So the industrial user goes to the physical market to buy what they need. And they discover that physical silver is not available at the paper price. Dealers are quoting premiums of 15%, 20%, 30% above spot. Delivery times that were normally 2 weeks are now 8 weeks. Minimum order sizes have tripled. The arbitrage that was supposed to keep paper and physical aligned cannot function, because the physical market does not have the volume to absorb the demand that is being pushed out of the paper market. Registered silver inventories at COMEX total roughly 80 million ounces. Daily trading volume in silver futures represents over 500 million ounces of notional exposure. The ratio is not close. If even 10% of paper holders demand physical delivery, the system has no mechanism to provide it. And this is not a problem that resolves itself over time. This is a problem that accelerates. When the first industrial user cannot get delivery and has to shut down a production line, their competitors hear about it. Those competitors immediately stop relying on futures contracts and start buying physical in advance. That pulls more metal out of available inventory. Premiums rise further. Delivery times extend. When the first pension fund holding a silver ETF realizes the fund cannot source physical metal to back the shares, they redeem. When they redeem, the ETF has to sell its holdings to raise cash. But if the ETF itself was using unallocated positions or futures contracts instead of fully allocated physical, they face the same delivery problem. This creates a cascading scenario where each failure to deliver creates another wave of buyers trying to secure physical metal, which creates another round of delivery failures. The price discovery mechanism, the system that was supposed to reflect the value of silver based on supply and demand, becomes untethered from reality. Paper trades at one price, physical trades at another, and the gap between them widens every hour. Traders call this a disorderly market. Regulators call it a liquidity event. But the accurate term is simpler. It is a mechanism failure. The machinery that everyone assumed was permanent stops working. And unlike 2008 or 2020, there is no central bank intervention that can fix this. The Federal Reserve can print dollars. They cannot print silver. The Bank for International Settlements can adjust reserve requirements. They cannot create physical metal that does not exist. Monday morning will test whether the decades-old structure of precious metals markets can survive the collision between regulatory enforcement and physical scarcity. The early indicators suggest it cannot. And once a market mechanism breaks, it does not repair itself quickly. For the business community watching this unfold, the critical question is not what happens to silver and gold prices on Monday morning. The critical question is what this regulatory enforcement signals about the broader monetary architecture that businesses operate within. The Bank for International Settlements does not make arbitrary decisions. When the BIS forces compliance on a regulation that has been delayed for 15 years, it is not responding to market conditions. It is preparing the system for something larger. Basel III was designed in the aftermath of the 2008 financial crisis to prevent banks from holding excessive risk in opaque derivative positions. But the timing of this particular enforcement, the NSFR requirement for precious metals specifically, suggests a deliberate reorientation of how central banks view reserve assets in an era of currency instability. For decades, the global monetary system has operated on the assumption that paper claims are equivalent to physical assets, as long as confidence remains high. Unallocated gold and silver accounts functioned exactly like fractional reserve banking. Multiple claims on the same underlying asset, all assuming that redemption requests would never exceed available supply. By forcing banks to hold 85% reserves against these paper claims, the BIS is effectively ending fractional reserve precious metals banking. They are saying that paper and physical are no longer equivalent, and that institutions must hold real capital against synthetic positions. This is a profound philosophical shift with implications far beyond the metals market. If central banks no longer trust paper claims on precious metals, what does that signal about their confidence in paper claims on currencies, on sovereign debt, on the derivative structures that underpin global finance? For corporate treasurers and business decision makers, this regulatory change should be interpreted as an early warning system. When the central bank of central banks begins forcing stricter capital requirements around hard assets, it suggests they see risks in the current system that are not yet reflected in market pricing. The immediate practical implications are straightforward. Any business with exposure to precious metals through ETFs, unallocated accounts, or futures contracts should understand that the counterparty risk profile of those positions just changed dramatically. The institutions on the other side of those contracts are now under regulatory pressure to exit or fully reserve those exposures. That creates settlement risk, delivery risk, and the possibility of cash settlement at disadvantageous prices. Companies that use silver or gold in manufacturing should anticipate supply chain disruptions. As banks exit paper positions and physical metal becomes more expensive to acquire, industrial users may face higher input costs and longer delivery times. Locking in supply through direct contracts with miners or refiners becomes more valuable than relying on just-in-time purchasing from financial intermediaries. For businesses holding cash reserves or managing corporate treasury functions, this moment requires a reassessment of counterparty exposure to the banking system. If major bullion banks are facing capital adequacy issues due to precious metals positions, what other derivative exposures might create similar stress in the coming months? Credit default swaps, interest rate derivatives, currency forwards, all of these operate on similar principles of leverage and paper multiplication. The timeline for how this unfolds matters greatly. In the next 30 days, businesses should monitor whether banks choose compliance or position reduction. If major institutions begin unwinding derivative books rapidly, that creates market volatility across multiple asset classes, not just metals. Credit spreads widen, liquidity contracts, borrowing costs rise. In the 60-day window, the secondary effects become visible. If physical precious metals prices decouple significantly from paper prices, it breaks the pricing mechanisms that industrial users rely on for budgeting and procurement. If banks reduce lending to preserve capital for regulatory reserves, small and medium enterprises face tighter credit conditions, regardless of their individual creditworthiness. By 90 days, the structural changes become permanent. Markets adapt to the new regulatory reality. Institutions that could not comply either exit the market or restructure fundamentally. The businesses that anticipated this shift and adjusted their supply chains, treasury management, and counterparty relationships in advance maintain operational continuity. Those that did not face disruption But beyond the immediate tactical considerations, there's a strategic pattern that demands attention. Basel III enforcement on precious metals is not an isolated regulatory event. It follows a sequence of central bank actions over the past 18 months that all point in the same direction. Central banks globally have been net buyers of physical gold at the highest pace in decades. Bilateral trade agreements increasingly include provisions for settlement in commodities rather than dollars. Regional currency arrangements are being tested that bypass traditional reserve currency mechanisms. The NSFR enforcement on Monday is one piece of a larger restructuring, a deliberate move away from synthetic financial claims toward hard asset backing. The business community should interpret this not as a metals market story, but as a monetary system story. This is not about speculation. This is not about trying to profit from short-term price movements. This is about understanding that the regulatory and monetary infrastructure that businesses have operated within for the past 50 years is being systematically reconfigured. The institutions that positioned themselves ahead of 2008 did so not by predicting the exact trigger, but by recognizing that excessive leverage in housing derivatives created systemic fragility. The businesses that will navigate the next phase successfully are those that recognize excessive leverage in currency and commodity. Derivatives creates similar fragility, and the regulators are now forcing that recognition. Monday morning is not the end of this process. It is the beginning of a multi-year adjustment where physical assets regain primacy over paper claims, where leverage is restricted rather than encouraged, and where the gap between synthetic and real becomes impossible to ignore. The question for every business leader is simple. Does your organization's strategic positioning assume the continuation of the old system or the emergence of the new one? Because Monday morning, the regulators just made their choice clear.